Have you ever heard of a regular software company that shot up in value by more than 3,200% in just a few years? Back in August 2020, Michael Saylor, then the CEO of MicroStrategy, now simply called Strategy, made a bold move. He bought $250 million worth of Bitcoin, convinced that inflation was eating away at his company's treasury and that Bitcoin was the answer. Fast forward to today. Strategy holds nearly 600,000 Bitcoin, worth over $64 billion at the time of filming, about 3% of the entire circulating supply. That single decision turned the company into one of the biggest corporate Bitcoin holders in the world, and it worked wonders for shareholders. MSTR stock has rallied more than 3,200% in just 5 years. So, how did they pull it off? Well, they basically built a massive, self-sustaining money machine, a Bitcoin treasury company, powered by three key pillars: what Bitcoin really is, how they keep raising more money, and a flywheel effect that just keeps spinning. Saylor's whole strategy rests on a simple belief. Bitcoin isn't just a digital commodity, it's digital capital. He saw that inflation was eroding the value of cash, so holding dollars felt like holding melting ice. Bitcoin, in his eyes, was pure economic energy, an asset designed to appreciate over time, outpacing stocks, bonds, and even the S&P 500. Because Bitcoin keeps appreciating, Saylor saw an opportunity. As the leader of a public company, he could tap the capital markets to supercharge Bitcoin accumulation. Think of it like running a refinery. The raw material is Bitcoin, digital energy. Strategy refines that into financial products, like stocks and bonds, that investors want to buy. Instead of asking investors to hold raw crude oil, he offers them polished, tradable instruments backed by Bitcoin. You might be wondering, with Bitcoin priced over $100,000, how does a company scoop it up by the bucket load? Strategy uses four main funding channels. 1. Operating cash flow. This part is straightforward. Strategy still runs its software business, selling licenses, subscriptions, support, and analytics services. In 2024, that brought in around $463 million in revenue. 2. Convertible debt. Investors hand over cash in exchange for low-interest bonds. For Strategy, this means billions of dollars up front, without immediately diluting shareholders. For investors, it's a win-win. If MSTR stock rises, they can convert bonds into shares for big profits. If it falls, they just collect small interest payments until maturity. 3. Stock issuance through an at-the-market program, also known as an ATM offering. Strategy can sell new shares whenever it chooses, with no fixed schedule or waiting period. This flexibility helps keep capital flowing. The main advantages? It's a low-cost, discreet way to raise funds. It avoids the heavy dilution of one-time sales and lets the company grab shares at the most favorable prices. Plus, agent fees are typically lower than full underwriting commissions. On the downside, ATM offerings can still lead to gradual dilution of existing shareholders, and sales may put downward pressure on the stock price if not managed carefully. Regulatory requirements such as updating prospectuses still apply. 4. Digital credit, preferred shares. Here's where things get really interesting. Strategy has designed hybrid securities called preferred shares. Think of them as sitting right between debt and common stock. What makes them unique is that they're engineered with Bitcoin as digital capital, combined with AI-driven structuring, to appeal to investors all over the world. Now, these preferred shares are perpetual, meaning they don't expire, and in a way, they actually give Bitcoin something it normally doesn't have: cash flow. Strategy has rolled out several different classes of these preferred shares, each designed for a specific type of investor. Let me break them down. Preferred share with ticker symbol STRK, or strike. This one pays an 8% dividend. It's designed with conversion rights, so investors get upside potential, plus some downside protection and steady yield. STRF, or strife. This pays a 10% dividend and sits senior in the capital stack, which means it's built for more conservative investors looking for extra security. STRD, or stride. Also a 10% dividend, currently yielding about 12.7%. This one is junior and non-cumulative, so it's higher risk, but also higher reward, especially for strong Bitcoin believers. And lastly, STRC, or Stretch. This pays a variable monthly dividend. It's designed for low volatility and short duration, basically competing with money market style investments. Why investors buy these preferred shares, you may wonder. Investors love these products for three reasons. First, high yield in a yield-starved world. Traditional safe credit yields almost nothing. Think near zero in Japan or even negative in Switzerland. Strategy steps in offering 8 to 12% because Bitcoin appreciates faster than the cost of capital. Second, over-collateralization. These instruments are backed by Bitcoin, often at multiples like 5x or 10x, giving investors more protection than typical corporate bonds. And third, risk management. For investors who want Bitcoin exposure but can't stomach its volatility, like corporate treasurers or retirees, these shares strip out the wild price swings while still paying reliable yield. Now let's talk about the critical funding detail. Those juicy dividends don't come from selling Bitcoin or from software profits. They're mostly funded by raising new capital, issuing more shares and allocating a slice to dividends while plowing the rest into buying more Bitcoin. In fact, Strategy sells about $20 billion worth of equity each year. Around 5% of that, roughly $600 million, goes to preferred dividends. The other $19.4 billion? Straight into buying more Bitcoin. That's why some critics call the model Ponzi-like. It looks similar. New investor money pays old investors. But here's the difference. Strategy runs a real business, invests in a real appreciating asset, and never guarantees returns. Michael Saylor is absolutely adamantly clear that Strategy will never sell its Bitcoin. This is a core principle of their investment thesis, holding Bitcoin indefinitely, even under adverse market conditions. Selling Bitcoin, according to Saylor, would undermine the company's long-term value proposition. Strategy believes in the scarcity and long-term appreciation of Bitcoin, viewing it as a treasury reserve asset. If Bitcoin ever enters a deep bear market, Strategy would look to sell derivatives instead. Things like Bitcoin futures, out-of-the-money calls, or basis trades using their holdings as collateral, before ever touching the coins themselves. The real engine of wealth creation is what Saylor calls the flywheel, a self-reinforcing feedback loop powered by market belief. Investors don't just buy MSTR stock for the Bitcoin it holds today. They buy it because they believe the company will keep accumulating more tomorrow. This creates what's called a multiple on net asset value, or MNAV. Here's an example. If Strategy's Bitcoin holdings are valued at $63 billion, but the company's market cap is $104 billion, investors are valuing it at about 1.7 times its net asset value. In other words, $104 billion divided by $63 billion equals 1.7x. That premium reflects the market's expectation that Strategy will continue adding more Bitcoin in the future. That premium exists only if the market trusts that Strategy can reliably grow its Bitcoin reserves. And that premium keeps demand strong for every new debt or equity issuance. Strategy keep raising money to buy more Bitcoin. That helps support Bitcoin prices. The result? Bitcoin holdings increase. The stock price rises. Credit collateral improves. The market awards a higher MNAV. That draws in even more investors for the next round. And the cycle spins again. Michael Saylor's financial engineering at Strategy has completely changed how companies think about treasury management. He's shown that Bitcoin can act as a superior reserve asset, one that lets companies raise capital, hedge against inflation, and build long-term value without draining their cash reserves. Michael Saylor's Bitcoin flywheel is a cycle that's proven powerful. Holding Bitcoin doesn't just protect against fiat devaluation. It's also boosted shareholder returns and attracted massive investor attention. No surprise, other firms are following the model. In fact, 177 public companies now hold Bitcoin as a treasury asset. Of course, there's one catch. This whole strategy works only if Bitcoin keeps doing what it's always done, going up over time. However, there's a hidden risk to this model. Many companies now hold Bitcoin on their balance sheets, and some, especially miners, have taken on significant debt to do it. If one of these highly leveraged firms stumbles and is forced to dump a large amount of Bitcoin onto the market, it could trigger sharp price drops, margin calls, and a chain reaction of forced selling across the sector. While the broader financial system may not collapse, the shockwaves inside crypto could be severe, exposing just how fragile a leveraged Bitcoin treasury strategy can be. But for now, with Bitcoin climbing and the market buying into the story, Saylor's flywheel keeps spinning, turning digital capital into massive corporate wealth. Thanks for watching. Don't forget to like and subscribe for more.